Welcome back, everyone. Our next speaker for this morning is Junaid Bray. Junaid is a portfolio manager at Laurium Capital. They manage the Nedgroup Investments SA Equity Fund. Junaid, welcome to you. Thanks for joining us.
Hi, Neil. Thanks for having me.
So, Junaid, I've got a lot of questions for you, which I think are very important, very topical for this market, especially given how well we've done over the past year or so. So, I guess brace yourself a little bit. Is that okay?
That's fine.
Okay, great. So, we've seen, let's say, plus 40% returns on the capped SWICs, right? Like, where have those returns come from? And I mean, the market's been so strong over the past year. Like, what are you seeing for the year ahead?
Yeah, I think it's a good question, Anil. So I think, look, we've had obviously 40+% on the local market last year, but I think it's important to point out that it was fairly narrow because we all know that, the gold price has been super strong, and into the last couple of months of the year, we saw the other precious metals, the likes of the platinum group metals, platinum, palladium, rhodium, etc., catch up quite a lot. So that also rallied. So I think if I look at that 40+%, I think a significant amount, substantial amount of that came from gold, PGMs, and then the rest of the market was kind of not as much of a contributor to that strong performance. I think we'd have a contribution from Naspers and Prosus, from the banks, etc. But I think the rest of the market still has lagged quite a lot. So I think that's actually where we're seeing a lot of opportunity, because despite that strong performance, I think the domestic side of the market has lagged a lot. And I think if we're looking at from a bottom-up perspective, there's a lot of upside from our banks, our retailers, some of our industrials and insurance names as well. So I think there's a lot of catching up to do. And I think with a bit of a better macro backdrop, because I think incrementally we're seeing more positive news on the macro side. So I think it's still fairly subdued, but I think incrementally positive news on the domestic side, which I think should drive domestic stocks higher.
I mean, you actually touched on a lot of important points there. We must definitely get into it in more detail just now as well. So, Junaid, what about the performance of, if you look at the South African equity market versus some of the other major markets out there?
So I think that's quite an interesting point, because I think if you look at, we know the macro backdrop for SA hasn't been great. We've struggled along at very low GDP growth rates. That being said, our domestic market has actually been super strong. So if I look at, not just last year, I think last year we did 40+% in local currency, but remember the rand strengthened quite a lot also. So we did actually over 60% in dollars last year, outperforming the S&P. But not only over last year, I think if you look at the compound growth over 5 years, we've actually outperformed the mighty S&P. Now, if you think about
that's hard to believe, eh?
The composition of the S&P with the Mag 7 stocks in there, and we know NVIDIA, the likes of Tesla, etc., what that's done, we've actually outperformed the S&P over 5 years in dollars, given a bit of a tailwind from a bit of rand strength also in the last year. But I think that's quite something, given the composition of the domestic market. So our domestic market has actually performed fairly well. But bear in mind, I think going back to my previous point, that despite the strong performance, I think domestic stocks haven't actually run that hard, and valuations are still very depressed, I think, on the local side.
There's definitely been that concentration. Hey, we must talk about that more as well in the precious metal space. But then what about, let's say, the fund performance now, compared to its peer group and benchmarks?
So the fund has performed, if I look at last year, I think we just about, over 40% ourselves. So just sort of matching the benchmark last year in what was a very concentrated market in terms of the performance. We spoke about how narrow that performance has been, but we managed to keep up in the last year. But at the same time, outperforming our peers by quite a significant margin in the last year. And I think, if you're going back over longer periods as well, I think we've sort of outperformed the peer group. If I look at going back over sort of 5 years and since inception, and I think our track record on our fund goes back over 10 years now. We started in 2014, so it's been over 11 years of a track record. And then I think we have gone through periods of underperformance, which is captured in those numbers. But I think when we look at, over rolling 5-year periods, we've outperformed the benchmark and the peer group about 2/3 of the time. So I think
that's an important number.
It highlights the consistency of the outperformance of the fund.
And Junaid, if we kind of zoomed into the past year now, what would you say were some of the big contributors to those returns?
So I think, look, we had substantial exposure to gold, but it was mainly through Anglo Gold. So we stock pick within that, and Anglo Gold stood out for us as a quality, diversified gold miner. So most of our exposure was through Anglo Gold. We also had exposure to some of the PGM names, which had performed quite strongly. On the domestic side, banks, we had large exposures to ABSA and FirstRand. And then Naspers and Prosus has been a core holding in our fund for a while, and last year was quite strong from that perspective. So I think some of those names had contributed quite significantly, as well as some of the other domestic names like Growthpoint, Remgrow, etc. Yeah.
I mean, especially this topic of the concentration in precious metals has come up quite a bit now. Like, what are your thoughts on it as a risk to the portfolio and to markets?
So look, it definitely is a risk, because when you have a sector that's run this hard, and it becomes a larger part of the benchmark and the market, if we do have a drawdown in those sectors, you could see our index come off quite a lot. So I think that concentration risk is probably rising, and we've been cautiously rotating and using that to take some profits on some of the names in that has done well in those spaces, and rotating that into some of the names from a bottom-up perspective, we'll be seeing a lot of upside. So the likes of some of the retailers, Mr. Price, etc. We've been adding into those names and those sectors.
I mean, if you put kind of gold and platinum together, how much is that off the market now?
I think you're probably looking at about a quarter of the market now.
Is it that much
combined?
Now?
Yeah.
Okay. Wow. Okay. I mean, obviously, if you look at pricing, I mean, PGM pricing and gold pricing must have driven a lot of the returns that you've seen in the shares themselves. I mean, what comments do you have about that? So
yeah, look, I think clearly there's gearing on these companies. When you get the commodity prices running this hard, you will see gearing. And look, we chose specifically, when I mentioned Anglo Gold, within the space. We certainly didn't start 2025 expecting the gold price to do what it did, but we chose Anglo Gold because we felt that the company itself had good fundamentals, and had the gold price fallen, it wouldn't have been in a bad position, because the balance sheet was in. There's no debt on the balance sheet really. The operations are, there's quite a lot of margin within the operations for a lower gold price. So we invested at the start of 2025 in Anglo Gold for those reasons. And similarly, with the likes of Impala, Northam, etc., we didn't go for the more geared ones, because we didn't have a very high conviction view that the prices were going to go up this high. And that's why we chose those names. But that being said, those names actually perform very well. With Anglo Gold has been one of the top performers within the gold space in 2025. And then, we were pleased with the performance of Impala and Northam as well. And then we also, during the year, we added to Valterra, which is the old Anglo-American Platinum. They changed their name as they've gone independent. It's now called Valterra. And we've been adding to Valterra, rotating out of Northam into Valterra.
I mean, hearing you speak about these strong balance sheets and good businesses does definitely speak to your philosophy, as we've come to know about capital preservation and just that emphasis that you guys place in your process.
Definitely, and I think, look, also what I didn't mention on the PGM side, on the platinum group metals, we had a optimistic view and a positive view on the complex of the precious metals, because I think, look, gold is a bit more difficult to call because it's a lot more sentiment driven. But when we can look at fundamentals on the platinum group metals more, because there's more of an industrial demand underpin from auto catalysts, etc. And it was our view for a while, and that the electric vehicle story was way too optimistic in terms of penetration rates and expectations. And you can see in the last year or so, 18 months, those expectations and targets have actually been backtracked. And it looks like internal combustion engine and the demand for platinum group metals and from auto catalysts will be around for longer. That was our base case. So that was the fundamental reason, and we still believe that even at these levels, there's upside on the platinum group metals, and that's why we hold them still in the fund.
Yeah, I think it'll be a while before I switch to an EV for sure. And then just in terms of South Africa's terms of trade, what has kind of gold and platinum pricing done versus the oil price, for example?
So I think, look, it's still, we think of South Africa not as a very big gold producer anymore in the context of where we were historically. That being said, it's still quite big. So I think, it's nearly 10% of our exports is gold, and then nearly another 10% of our exports are platinum group metals. So combined, they come probably about 20%. And in terms of oil, we import that's about 20% of our import basket. So the two kind of offset each other. And we know now we've seen very strong gold and precious metal prices, and we've seen a relatively weak oil price. So I think that bodes very well for our terms of trade. And I think those numbers actually haven't really come through yet. So we're expecting very strong positive trade surpluses, especially if the prices continue to hold where they are. I think, gold recently went through 5,000. So it continues to run higher given all the geopolitical risks and volatility underway. So I think that's quite an underpin for the prices. And I think it bodes well for a stronger currency and better trade flows. So, and then I think linked to that, the other side of it is the economic benefits from the higher tax receipts that the companies will be printing much better profits. So they'll be paying much more higher taxes, and then also bonuses to employees. So I think that starts filtering down as second round effects and secondary effects through the economy that you'll see around those, especially around the Platinum Belt in the Rustenburg area. I think we should start seeing that in the next probably 6 to 12 months starting to come through.
Yeah, it does seem like it. And then Junaid, I guess just turning to valuations now. So if you look at kind of the SA bond market versus the SA equity market, I know one of the comparisons you track is kind of the forward PE versus bond yields. It does seem to be a bit of a dislocation there. What are you seeing at the moment?
So that's a very interesting one, because historically there's been obviously a strong correlation between our bond yield and what our domestic market trades at. Because if you think about the government bond is your risk-free rate, and your equity market gets priced off that. So the two tend to move in sync if you think of our local market in terms of an earnings yield perspective. And this time around, we've seen a very big dislocation. So we know our bond yield has been very strong. We've gone almost close to 8. It's the strongest it's been in a long time. But our domestic equity market hasn't really. We kind of, when we look at an index of domestic stocks, which really strips out all the rand hedges and the mining companies and focuses on mainly domestic companies, the likes of our banks, our retailers, and our local industrial companies, they're trading, close to what they've traded at, in the last probably 10 years or so. So it doesn't look expensive at all. It probably looks cheap to fairly valued. And I think the missing link there, I think the market questions the growth element, because I think that's the other component. If the market believed in higher growth, then I think you'd see that gap narrowing. So we certainly see that's a dislocation, and especially with the likes of our banks, which prices very closely off the government bond yield, that there's a lot of upside just on a lower risk-free rate, which we think is largely sustainable.
Yeah, because if you look at South Africa against some of the major markets out there, it does seem from a valuation perspective still very cheap. Like, what do you say about that?
Definitely, and I think that's where the growth element comes in, where I think global investors also, I think a lot of global investors tend to be more top-down when they allocate to different countries, and when their starting point is a very low expected growth environment for South Africa versus other emerging markets or other developed markets, they tend to put us at a discount, or they demand a higher premium to be invested in a lower growth environment. And I think that's the missing link. And again, coming back to our earlier points about tailwinds, economic tailwinds, I think incrementally there's a lot of positivity that we're seeing, and I think it's not being priced in, that the upside risks to our GDP. It's certainly from, if commodity prices are sustained higher. And then also I think with the weakening dollar, I think that's also supportive of emerging markets. Because I think, as trade flows are moving away from the dollar, I think emerging markets are a key beneficiary. High commodity prices, so we benefit from both. We're still largely a commodity producer. And if you look at the composition of our local market, we spoke about a quarter being precious metals, but there's the other side of diversifieds that you add to that. So there's, the resources so we're still quite, from a market perspective, commodity rich. And so you got that and the tailwind of a weaker dollar.
Just before we move on to portfolio positioning, is there anything else on outlook you'd like to mention specifically?
Look, certainly, again, to stress the point that there's incrementally positive news flow coming through from an economic perspective. So I think which is not being priced in. So I think if you just take a step back, I think no one really talks about load shedding anymore. I think that's behind us. Then the next leg that you're seeing positive movements on is logistics. So if you look at the 2025 numbers from Transnet in terms of rail volumes, etc., it definitely bottomed the year or two before that, and 2025 actually saw an improvement, and that's before we're seeing major private sector investment to really improve our logistics infrastructure. So I think that's the second leg that we'll see that will drive better GDP growth through the economy. So I think incrementally, definitely there's, and you know that I think the other point about the tax receipts, I think just about a year ago at our last budget, there was a bit of a debacle about, a disagreement about getting the budget through because between the GNU parties about higher taxes. I think with the higher fiscal receipts that we're seeing, or that we should see with high commodity prices, it certainly takes a bit of that pressure off. So I think, we could see a bit of a tailwind from that angle, that, there isn't a lot of pressure to increase taxes, which should also bode well. And then I think also from an interest rate perspective, given the lower inflation and the stronger rand, I think it does paint a backdrop of lower interest rates being sustained for a bit longer, which should also be, conducive to higher economic growth.
Yeah, no, definitely. It sounds like it. So Junaid, just on portfolio composition and positioning then, anything in particular you'd like to highlight, please?
So I think it's important to always, our starting point is always to have a diversified portfolio, to diversify away from risks geographically, as well as within sectors and factors. So I think, we've got a reasonable exposure across the commodity side. We've still got a significant exposure to gold. We're still reasonably positive on the PGM space and diversified miners as well, mainly through Anglo and Glencore. Then I think, if I look at it, where we're most excited about is actually the domestic SA side. And there, I think banks are our preferred play because we think that, the first round effects of economic activity, we think it will come through on the banks, where corporate lending, we're seeing that's already started to pick up. The consumer lending side is still lagged somewhat, so we haven't seen that pick up yet. And I think that's possibly the next leg. But I think certainly we're in an environment where corporates feel, more confident. Corporate lending will pick up, and I think the banks will be beneficiaries there. And then I think, we have been adding to the likes of the retailers. We've spoken about the lower interest rate environment. The valuations on the retailers are extremely depressed. So we've been adding selectively and cautiously there. And then we've still got, some of the insurance names in the portfolio, the likes of Sanlam. We've been adding to Discovery in the last while. And we're seeing good opportunities in the market.
Junaid, brilliant. Thank you so much. We really appreciate having you here.
Thanks, Anil.